Welcome to Power Charting. Do stocks have bad breath? The technical term is stock market halitosis. And with me today is Professor Scan, Johni Scan. John, welcome.
Great to be here, Professor.
Well, we're going to not only talk about breath, which is so useful, so powerful, but we're also going to have Professor Scan here do a scan exercise for us to illustrate how the scanning engine can help us in finding stocks that, well, first of all, identifying the characteristics of breadth, and find stocks that are performing well or badly, either way. And so, John, that's what we're going to do with our scan today?
Very exciting scan. We're going to look at stocks and the relationship to the 50 and 200 moving averages.
Nice. But first, the best of Wyckoff 2023 Unconference in San Francisco, Golden Gate University, such an important place, July 13th and 14th. And John, you going to be there?
Oh, absolutely. I'm going to be there, and we are going to talk all things scanning, your questions answered. Really looking forward to it.
Fantastic. Well, I'm really looking forward to getting back to GGU and being in those hallowed halls and being with just such a great group of Wyckofians and our Wyckoff community. So I'm very excited about that. Let me start, though, with a review of the discussion that we had last week. And I'm just going to get right to it. This is a 50-year chart of the New York Composite Index. And it's just a remarkable chart in my estimation. And it has this beautiful trend channel that has taken place from the 74 lows and connecting the 82 lows. And we call this lower line a demand line. And then the upper lines, which are parallel, are called overbought lines. You can see how well these overbought lines worked. And each time in this very large stride of an uptrend off the 74 lows, every time we had an important reversal back either to an overbought line in this case, or in the 09 lows where we dipped below the demand line, that was a period of high economic financial stress. And so in each case, the system got to work in the form of the Fed and the Treasury and other central banks and started to add liquidity aggressively to the system. And this was able to really kick off the next bull market run. And so we can see these red arrows represent these periods. 2020, where look at the loss of momentum in that run up there into the 2018, 2019 highs, and then that break of the demand line. Well, it got pretty deep, but the Fed came in, got to work, sent interest rates down to about the zero bound, and produced a really nice uptrend in stocks in 2020 into 2021. And here we can see, let's bring, and this is bringing this data up to date. The reason I wanted to show you this chart is because we now have the end of April data. This is May 3rd. And we're going to watch this chart very closely going forward. And John, what I really wanted to show here with this cutaway is the fact that we really need the market to rally back into the channel. And this, I would say this is in the course of the next few months. And because these are monthly plots. But the reason this arrow here is yellow, John, is because the Fed's not in an easing mode right now. They actually raised interest rates yesterday and raised them another quarter point. And rates now are at Fed funds rate 5.25. So that's pretty high up. And so the difference here versus these other key lows is really the posture of the Fed at this point in time. So a concern that I have, John, and then I'd love your comment, is that if we do start to fall away from this demand line from below, which is accompanying a secular shift in trend of inflation from disinflation. This whole period was from the 82 lows was disinflationary. And now all of a sudden we're in a period where we have inflationary characteristics. I wonder if we couldn't get back down to these key prior lows and maybe start a more important, maybe I'm thinking a trading range. What are your thoughts, John?
Well, certainly the macro dynamics are changing, and the tail end of the line in the focus area is reminiscent of M2. It's reminiscent of the shrinking of the money supply in the last quarter. So combination of higher rates, lower liquidity, bond roll-off on the Fed balance sheet, number of factors are on a macro basis affecting what we can expect from stocks, perhaps.
So we're going to watch this as a key characteristic of whether or not the secular trend can remain in force, the stride can stay up. And there is a case for that, actually. And we talked about that last week. But here, let's get into breadth, because this is such an important part. And this actually will speak to the more local characteristics of the market and how we could potentially have a rally going forward from here. So this is the NASDAQ Composite, and this is a form of breadth characteristic. The top cell is the advanced decline on a 10-day moving average basis. So advancers minus decliners, just 10-day moving average, oscillates around the zero line. And so we look for oversold condition and overbought condition, and we watch for the characteristics of divergences like we had here. And we look for, in the case of overbought, divergences, which we got here. And so the thing that I want to point out is that, and this actually is I think potentially a positive, is that we see that this is up volume on a 10-day average basis, and this is down volume on a 10-day average basis. And John, right now, we have the jaws widening here between these two data points. And when they get sufficiently wide, and I highlighted some of them, not all of them, the more moderate ones, is when you get the jaws widened like that, that often represents an important oversold condition. And so here's an example here, and so on. And so I think we could have a little bit more of this, but I like the way that the market is just working its way sideways here and not going down with an oversold condition building in the breadth data. So your thoughts?
Well, certainly the jaws are widening, but the market's not necessarily responding poorly at this point. It'll be very interesting to see what that yields.
Right. Very good point, because what we could see happening is we could have one last jolt of a corrective shakeout, which often comes at the end of a consolidation period like we have now, where this could break down into a spring. And John does a great job of picking up springs in his newsletter. And so you could have this thing spring this low and then start to go up from there. And this all has the potential to be a big accumulation structure. And I'll show you another example of that in a minute. John, concluding thoughts before we move on to another slide?
Well, like to see some springs. Springs have been fairly sparse lately. A lot of negative interactions with overhead resistance, and now a fair number of breakdowns, failures at support. So a little bit of a change is being detected in the Wyckoff scanning world.
Fascinating, because John actually keeps track of the counts of these different setups in his letter. But here, I just want to point out that the directionality of this overbought, oversold index continues to be down. So that would be our default position, is to expect continued internal and potentially index weakness as we go further into this oversold condition. Now, let's talk a minute about seasonality, because Dimitri Speck, who's created this incredible scanning engine, is going to be speaking on May 25th, and it's free to attend. I'll be hosting ifta.org, and please join us if you can, and also there will be a recording. But this is very cool, because this is the NASDAQ 100. Now, I'm bringing this up to date through the end of the quarter, the end of the month, through the end of April, because the first 2 weeks of May are moderately weak. That could coincide with the weakness that we think may show up in the breadth information we just looked at. Also, note how beautifully seasonality is rhyming with the NASDAQ 100 currently. That's a really interesting picture right now. And so to have a couple weeks into May pull back some could be very consistent with the data we just looked at. And then we have strength from there into the end of the quarter, into July. So that might be a script to follow. Markets can deviate massively from seasonality, so we always need to be looking at the tape to help us to understand where we are. Now, quickly moving on, I want to get into breadth, because this chart really does correlate with what John's going to talk about today. And that is that if you look at the bottom cell, that is stocks on the New York that are above their 50-day moving average. And that indicator currently is at a very low 34%. Only 34% of stocks are above their 50-day moving average at this time. How would you interpret that, John?
Well, certainly being above the 50 is generally regarded as part of an uptrend. Here, fairly low number exhibiting characteristics of an uptrend. Little concerning.
Such a good point, too, because if you look here at, here's sort of the 50 line. And when you get above, around 50 and you get above it, that often is the time when you have the market really broadening out. And this is just a big trading range, potentially accumulation, but court's still out on that. But when you can get the trend, first of all, directionality is important on this. We've talked about it before, but trend is important. We don't have an uptrend right now. It's at best a trading range, and it's below 50%. But once we get a majority of stocks, remember, this is just looking at each stock compared to its 50-day moving average and whether it's above or below. And we want this indicator to be in a rising trend. We love divergences off the low, and we will often look for trading opportunities off those oversold conditions. But the real action occurs when you get above the 50% level. That's when you can have really dynamic upward trends. Here we've had an upward trend and really no penetration of the 50% level. So it's a narrow market. It's a market that doesn't have a lot of participation. And so let's look at common stock advanced decline line information. This is, I think, such a very, very valuable indicator, breadth indicator, and it is just looking at New York Stock Exchange only common stock advanced decline. It doesn't have any capitalization characteristics. It's just one stock, one vote, and these are common stocks only, no preferred stocks, nothing that trades like a stock but is not a stock, common stocks only. And what we really want is we want to identify periods when we have a term commonly used today is alpha. And that's a period when you have a real positive upward trend. Well, let's define trend by the common stock advanced decline line and look at it and look at its trend either being up or down. And so here we can see across here a trading range. This is 2020. Now it's a trading range with a slight upward bias to it, and it actually started up down here, but once it gets going, this is a market that has tremendously positive alpha because the vast majority of stocks are trading up, and it's getting stronger and stronger because of the higher highs in that uptrend. This is an environment where trend followers can position stocks and have good returns in those stocks when you have that upward stride. The chart in the middle is the S&P 500, and the S&P 500, look at how it is rising with the advanced decline indicator. And also the bottom one is the New York Stock Exchange Composite, which also, both those are cap weighted, and that's also rising. So John, I think this is the key, is to patiently wait for the opportunity to participate in these upward striding trends.
Absolutely. The advanced decline line, very, very informative.
So now look what happens. That's an easy money environment where the Fed is very accommodative throughout that whole period. Now look what happens, and this is the real tell, is that you can see that the advanced decline common stock only data here in the yellow shaded box at the top is going sideways in a trading range while the market continues to push higher. That is a measure of diminishing participation, reduced numbers of stocks participating in the uptrend. Thus, the probabilities of success in your trades is diminishing. Probabilities are decreasing for success in trading because of the breadth deteriorating. This turns out to be an important top. This has classic distributional characteristics. With sign of weakness here, last point of supply. This is a lower high and a lower low, setting up a downtrend. And look what's happening. The S&P 500 made a new high on that. But we, because we're looking at the breadth data, are being warned that the number of stocks participating in the market is diminishing as time goes on. This is a massively worthwhile piece of information for us to have. It's a selective market. And lastly, because I want to get on to Johni Scan, is here is a tight money environment, hard money, because the advanced decline common stock only indicator is dropping. Stocks are falling on the indexes. This is an environment to be low to the ground, super defensive, and wait for the next potential rally. And so in future episodes, we'll talk more about the current environment and what we can derive from this indicator for where we are currently. The only thing I'll say here is we are making higher lows and lower highs. And so we're in some kind of a large volatile trading range and potentially could finish a higher low and then start to trend up again. So we'll talk more about that next time for sure. And with that, John, let's get on to your material here and talk about your scan. Tell us what you have here.
Fantastic. Well, very, very simple scan looking at the current stocks that have the 50 moving average over the 200, and we're going to compare that same metric, but 21 days ago. So here we have the scan, advanced scan workbench, easy to use. We're going to scan within major indices, Dow, S&P 500, NASDAQ, S&P 400 for the mid-cap level. There is duplication in some of these, so the numerosity could be subject to question, but figure there's at least probably about 1,000 stocks that can be pulled here. And first scan we're going to run is simply, as of the last close, the 50 is greater than the 200. We're also going to sort this by the percent difference between the 50 and the 200. In this particular case, that will give us the largest numbers first. So NVIDIA is at the top of the list, and its current price is, or the current SMA 50 is 39.4% above the 200. So that's the metric. Doesn't have anything to do with today's price or yesterday's price, simply the distance between the two lines, and where price is relative to that, different issue, but we're going to look at that too. So some form of relative strength almost you're getting with respect to the distance between the two lines. Then we can roll this back 21 days. So we have the second line of code. We just double slash the first line that comments it out, makes it inactive, but it's still there for our eyes to see. And 21 days ago, SMA 50 versus SMA 21, both set back 21 days. And then we just count the number of stocks that were responsive to that request 21 days ago. So in the first instance, we had 503 current stocks, and 21 days ago, we had 603. So probably a 15, 18% difference 21 days ago, more stocks above the 50, or excuse me, the 200 above the 50. Today, 503. So we do see some degradation in that metric. This is a way to use the scan engine to simply give us information about breadth in the market. 21 days ago, more stocks, 50 above 200. Today, 18% fewer, something of that nature. Let's take a look at some of the stocks that we brought up, and let's ascertain exactly what we were measuring. So the red line is the 50, the black line is the 200, and our measurement here is the distance between those two. That's in combination with the ranking. So the first criteria is the 50 is above the 200, and the ranking criteria is what is that distance. And here we have a very, very interesting NVIDIA stock. Gives us almost a peek into relative strength too, because we see balance of volume all up. 50 crossed the 200 some time ago, gave us a nice move up. Relative strength to the VTI, Vanguard Total, very nice. And the scooter value really has maxed out at 99 plus. So very, very interesting strength picture here from NVIDIA. Now, our next stock gives us a dramatically different picture because, again, we weren't looking at where price was. We're simply looking at the distance between the 50 and the 200 and ranking by that distance. So here we've had a dramatic, almost waterfall decline after a very significant run up. And we see all of our metrics have degraded substantially, but yet the decline here is approximately 50% of the run from the October lows to the April highs. And on a Fibonacci basis, it's not unexpected to have that. So very interesting, and note where that waterfall decline stopped, just in the area of prior overhead resistance, potentially now acting as support. So we can learn a lot simply by looking.
So John, your scan would pick up the stocks that are crossing the 50 above the 200, even if they're just slightly above it. It's still going to qualify and pick that up, because I'm noticing that these really good leadership stocks, such as Allegro and NVIDIA both have beautiful accumulation structures that precede these big markups. And so this scan could pick up these concepts or these ideas as they're emerging.
That's correct. If we reversed our sort order, we will get the stocks that have the smallest difference between the 50 and the 200. But remember, the search criteria is the 50 has to be above the 200. So should always be a positive number
and then we can
on the percent difference.
We can check these characteristics as we go through and put eyeballs on these stocks, which is what you want to scan to do.
Exactly.
So here's GE.
Very positive look here. Lots of strength. Good slope on the 50. Upslope on the 200. Relative strength. Great. Look at that nice basing action. Double bottom. Whatever you'd like to see. Potential reverse head and shoulders. The balance of volume is very, very positive also. Lot to like here. And look at how it keyed into the cross to 50 to 200. Very, very important metric. And that's one of the reasons why I selected it for a scan, the Golden Cross. And this scan gives us perspective of how many stocks have maintained that position. And we see that that has come down somewhat significantly over the past 21 days. And that tracks with the breadth information that we saw from all of Professor Bruce's charts. Engine is a great way to extract information about the market. So
terrific.
That's what
and
we've
John,
done.
this is an exercise that we're doing that's going to be an ongoing effort on John's part, our part, to identify and improve our breadth tools for scanning, looking for best ideas, but also how breadth can help us to get the right measure of what's really going on in the stock market at a point in time. John, thank you so much for being here.
Great to be here as always.
And thank you all, and we will see you next time on Power Charting.